As he said, my name is Mary Joseph, and I am from FarmDrive. So this is Labun. Labun is a farmer from Kampiamoto, which is a rural farming community in Kenya. I had the pleasure of meeting Labun back in June when he gave a tour of his farm to the FarmDrive team. Now, I don't speak Swahili, so I wasn't really able to communicate with him as well, but he was extremely kind, and I could sense the passion and pride he had for his farm. However, behind his smile was a sense of worry and uncertainty. His crops had been dying because there had been little rain in Kampiamoto, and he did not have the capital to purchase an irrigation pump. His neighbor, however, did have an irrigation pump, and as you can see in this photo, it's pretty clear which side belongs to Labun and which side belongs to his neighbor. This lack of access to capital is a problem that affects 50 million smallholder farmers throughout Africa. Although 65% of Africans are employed through the agriculture value chain and 32% of Africa's GDP comes from agriculture, only 6% of commercial lending actually goes to the agriculture sector. This contributes to the $425 billion global funding gap between financial institutions and farmers. This means that throughout Africa, there are farmers who are unable to purchase the quality inputs they need to increase their harvests, increase their incomes, and escape poverty. So what are the causes of this funding gap? Well, there are several. First, financial institutions are ill-equipped to really assess the risk of lending to smallholder farmers. They use traditional methods of risk assessment that rely on business records, access to assets, and also credit histories. In addition to this, they're located in urban areas, and they rely on loan officers to physically go out to the locations of these businesses and assess the risk, including faraway rural farms. Not only is this extremely time-consuming and costly for financial institutions, it's also not feasible for smallholder farmers. They don't keep their business records, they don't have assets, and they don't have credit histories because they've been locked out of the formal financial sector due to the reasons I've already mentioned. Thus, since financial institutions are unable to assess the risk, they simply don't include smallholder farmers within their portfolios. This means that smallholder farmers are unbanked and financial institutions are unable to reach a huge untapped market. That is, until now. At FarmDrive, we've developed a credit assessment model that's based on mobile phones and data analytics. We aggregate numerous streams of alternative data and use them within a comprehensive credit profiling algorithm. This algorithm pulls together 3 categories of data: individual data, social data, and environmental data. The individual data is pulled directly from farmers, right from FarmDrive's mobile application, which farmers use to apply for loans. The social data is based off of the farmers' social interactions. This includes the interactions they have with other farmers and the interactions they have with FarmDrive and our application. Finally, we use environmental data. This environmental data is pulled together from alternative sources of data that come from Kenya and abroad, including agronomic data and market prices. Most recently, we've incorporated satellite imagery and remote sensing data. An example of how we use this data is analyzing vehicular density or roof composition to determine the GDP of a particular area. So when we combine these 3 categories of data, the algorithm is able to generate a credit profile and loan terms for the farmer. The algorithm generates the credit profile by assigning the various data sets that we bring together to 4 different parameters: character, conditions, capacity, and capital. The character score is determined from the social data, the condition score is determined from the environmental data, and the other 2, capacity and capital, are created from a combination of the individual social and environmental data. Once these scores are created, a farmer is then put into one of 3 risk bands: high, medium, and low. That is how the credit profile is determined. We then combine this credit profile with previously determined business rules from a financial institution, such as risk appetite and interest rate, in order to generate the loan terms. This means that at the end of this process, we're able to tell a financial institution the exact amount, loan term, and grace period at which they should lend to a farmer. So Other than our algorithm, what really makes FarmDrive stand out? Well, it's the incredible group of people that we brought together to make this solution work. FarmDrive is a homegrown solution. The founders, Rita Kimani and Paris Bosiri, both grew up in rural farming communities in Kenya, and they witnessed firsthand the struggles that farmers all throughout Africa go through. After graduating with first-class honors from University of Nairobi in computer science, they founded FarmDrive and brought together their expertise in data analytics along with their knowledge of smallholder farming in Kenya to found FarmDrive. In addition to the expertise brought by Rita and Paris, we've also put together a phenomenal partnership ecosystem of organizations that are leaders in their fields. There's really no one else bringing together this amount of data and this level of expertise to solve the problem of agricultural lending. And although we're a young company, we're looking forward to bridging the funding gap in Kenya and eventually all throughout Africa. And I'll tell you that Lubun got a loan from FarmDrive, and he now has a irrigation pump. His crops are well watered, and he's looking forward to a very bountiful harvest. Thank you.
Just share a little bit around how you acquire your customers and how you're going to market.
So as I mentioned, we have a partnership ecosystem, and through that, we're able to acquire large amounts of farmers. So for example, we work with large farmer organizations, and through that, simply by having a connection to the leader of that farmer organization, we're able to have access to all of the farmers within those organizations as well. We go to their meetings, we train them on how to use the application, and they're able to register and apply for a loan right there.
Great. With the 350 loans issued, that's what is your loan book performance? What does it look like at the moment?
So right now it is pretty early to give an overall, I guess, estimate of what the loan book will look like. We have, as you said, we've lent to 350 farmers. There have been about 5 defaults out of 100 loans that have been active, but it's a very small data set at this point in time. But over time, as more loans begin to fall due, as we lend to more farmers, we're going to have a more robust idea of how accurate our algorithm is working.
Thanks, Mary. And just in light of that, looking forward, from a trajectory point of view, can you give us a little bit more information about the pipeline of number of loans to come?
Yeah, so by the end of 2016, we're looking at reaching 10,000 farmers and lending to 2,000 of them. By the end of 2017, we're looking at 70,000 farmers. So this is through the various partnerships that are in the pipeline right now. We're adding more financial institutions to our platform, more farmer organizations, and really refining our algorithm as well. As I mentioned, we just started incorporating satellite data and remote sensing information as well.
Just a question for myself in terms of client acquisition. One of the biggest challenges, obviously, in SSA is around subsistence farming. Is there any conversation around proactively acquiring customers that might make geographical sense, and hence they can kind of pool their land together and get more kind of output from that piece of land? So really the question's around, are you proactively seeking customers or farmers to lend to, subsistence farmers to lend to, that are within a similar geographic region?
Yes and no. So we are proactively looking for farmers. However, rather than trying to concentrate our efforts within one geographical region, we really do have it spread throughout Kenya for 2 reasons. One, for risk mitigation. If all of your farmers are in one county and that county experiences a drought or there's a pest infestation, that really kind of destroys the loan book for that county. The second reason is for data purposes. We see our solution as being something that's not only relevant for Kenya, but relevant for all of Africa. So in order to make that happen, we need to have data sets from various different regions. So right now we are in Kenya, and therefore we're trying to gather as much data as possible, including repayment data of farmers in different regions. And as we expand, that'll hold the same for various countries.
Hi, I have got 2 questions. One is about the farmers. Are you also particular about which type of farmers you have in your system? Whether it's different types of cash crops, and do you distinguish between those? And the second question is, what is your largest challenge now going forward? Is it more of a bottleneck for you to get more farmers on the platform, or is your challenge more to get more funders on the platform?
Okay, so your first question, how do we get repeat it again, sorry.
No, so when you look at the farmers that you want to serve, do you distinguish between the types of farmers, the type of cash crops and sort of their sort of harvest cycles? Are you particular about that, or is any smallholder accepted?
We are particular in that our solution is based on data. So we primarily lend to farmers for whom we have data. So for example, if you're a tomato farmer and we have data about tomato crop cycles, we'll lend to you. But if you grow a crop that we don't have data on, then our solution doesn't really work. As I mentioned, we are gathering more data, and right now we're focusing on horticulture, but we're expanding to more crops. And then in terms of, what's your second question?
Your biggest constraint. What is it that you need to focus on most in order to grow? So what's your biggest growth constraint?
So not really farmers. We actually have many farmers who are interested in the platform and are registering every day. I think our biggest challenge currently would be financial institutions and their risk appetite and their willingness to kind of grab onto this new technological solution. Moving forward, I think it's been kind of a theme of the panels and the pitches thus far, but regulations. When we meet with governments, or government officials, the first question they ask us is, who regulates you? And we say, well, no one, because what we're doing is really new. A regulation body hasn't been created yet. So I think moving forward, a challenge might be, trying to work around whatever, not work around, but not being hindered by whatever regulations end up coming up as more people and more companies enter this space.
I do have a follow-on question, and if I may. So if your biggest constraint is to find the financial institutions to join you on your platform, what are your strategies to tackle that constraint?
Our strategies are really working with financial institutions that are ready for this type of data analytics platform. As I mentioned, most traditional financial institutions are really wary of this. So we're working with financial institutions that are seeking this, that are already trying to figure out ways to lend to smallholder farmers. And we can say, hey, we actually have a solution for that, as opposed to trying to convince somebody who doesn't even want to lend to this group of farmers, to convince them that they should not only lend to an industry that's inherently risky, but then also do it based on data that they might not be familiar with.
And do you have strategies also to de-risk for them? So do you have...
De-risk for the financial institutions? Yes, so the insurance de-risks for the financial institutions as well. It helps the farmers because it is weather-based, and so, or weather indexed. So, if there's any indication of drought or excessive rainfall, they will receive the payout. And then also for financial institutions, it also protects them from the inherent risk of agriculture.
A quick 30-second question. Do you do cooperative insurance as well? So stock fells, for example, in South Africa, to de-risk your portfolio, would you look at community-based farming lending or just individual farmers?
As of right now, we're looking only at individual lending because our platform is so tailored. It's based on a specific farmer, what they're specifically growing, where they are, et cetera. In the future, we may end up looking at group lending, but as of right now, in the early stages, we're just doing individual lending. Thank you.